Picture a Thursday evening in late January 2021. Trading desks across lower Manhattan are emptying out, but the screens are still glowing. In thousands of apartments and houses across America, people are staring at their phones, watching a stock ticker that has become something far more than just a number. GameStop, a struggling video game retailer that most people had written off years ago, is trading at prices that make no sense to anyone who learned investing from traditional textbooks. What happened to turn this forgotten mall store into the center of a financial earthquake? Why did millions of ordinary people suddenly decide to challenge some of Wall Street's most sophisticated money managers? And what does this story reveal about the changing nature of markets, information, and power in the age of zero-commission trading apps? Before we venture deeper into this story, take a moment to like this video and subscribe, but only if you're drawn to the kind of financial history that reveals patterns beneath the surface. And if you're still listening, leave a comment telling me where you're tuning in from tonight and what brought you to this moment. You might be listening to this in bed, perhaps after a day of watching your own portfolio, or maybe after hours of scrolling through market news and feeling overwhelmed by the noise. This story is not about telling you to chase the next squeeze or join the next movement. It is about understanding what happens when old rules meet new technology, when emotion collides with leverage, and when millions of individual decisions create consequences that nobody fully predicted. So settle in, let your breathing slow, and let us walk through this chapter of market history together, calmly and clearly. The world that gave birth to the GameStop story began long before January 2021. For more than a decade after the financial crisis of 2008, interest rates in the United States had been historically low. The Federal Reserve had kept borrowing costs near zero to support the economy through crisis and recovery. This environment created a particular kind of market psychology. Money was cheap, and investors searching for returns had pushed into riskier and riskier assets. Hedge funds, those private investment partnerships that cater to wealthy individuals and institutions, had multiplied and competed fiercely for edge and alpha. Many had turned to a strategy called short selling, betting that certain stocks would fall in value. At the same time, technology was quietly revolutionizing who could participate in markets. In the years leading up to 2021, a new generation of brokerage apps had emerged, led by companies like Robinhood. These platforms offered something revolutionary: zero commission trades and fractional shares. Suddenly, anyone with a smartphone and a few dollars could buy stock in Apple or Tesla. The barrier to entry had collapsed. What once required phone calls to expensive brokers and minimum account balances now happened with a few taps on a screen. Millions of younger Americans, many of whom had watched their parents struggle through the financial crisis, began opening accounts and learning about markets through online communities rather than through financial advisors or business school. One of those online communities was a section of Reddit called Wall Street Bets. Founded years earlier, it had grown into a gathering place for retail traders who shared screenshots of their gains and losses, often with humor and self-deprecating honesty about risky bets. The culture was irreverent, sometimes crude, but beneath the memes was a genuine interest in learning about options trading, technical analysis, and market mechanics. By early 2020, Wall Street Bets had around 2 million members. These were not billionaires or institutional portfolio managers. They were teachers, engineers, students, nurses, people working regular jobs who had become fascinated by the puzzle of markets. GameStop itself was a company caught between two eras. For decades, it had been the place where millions of Americans went to buy video games, consoles, and accessories. Strip malls and shopping centers across the country had a GameStop store with its red and white logo. But the world was changing. Digital downloads were replacing physical game discs. Sony and Microsoft were building online stores directly into their consoles. Amazon could deliver games to your door faster than you could drive to the mall. GameStop's sales were declining year after year. The company was closing stores, cutting costs, and searching for a new identity. To many investors, especially those who had studied retail industry trends, GameStop looked like the next blockbuster video, a business model that technology had passed by. Short sellers noticed this. Short selling is a strategy where investors borrow shares of a stock, sell them immediately, and hope to buy them back later at a lower price, returning the borrowed shares and pocketing the difference. It is a bet that a stock will decline. It can be profitable, but it carries unique risks. When you buy a stock, the most you can lose is what you paid. When you short a stock, your potential losses are theoretically unlimited because a stock price can rise without any ceiling. Despite this danger, short selling had become deeply embedded in GameStop. By late 2020, more than 100% of GameStop's available shares were being shorted. This technical oddity, called over 100% short interest, meant that through various lending chains, shares had been borrowed and re-lent multiple times. It created a crowded trade, with many hedge funds essentially making the same bet that GameStop would continue falling. Among the investors on Wall Street Bets, a few individuals began to notice something interesting. One user in particular, who went by the name Roaring Kitty online, and whose real name was Keith Gill, started posting detailed analyses of GameStop. Gill was not a billionaire or a professional fund manager. He worked in financial services and had been studying GameStop carefully. His thesis was simple but contrarian. Yes, GameStop was struggling, but it was not worthless. The company had some cash, loyal customers, and perhaps most importantly, it had the potential to transform itself. In the summer of 2020, GameStop hired new board members, including Ryan Cohen, a young entrepreneur who had built the successful online pet supply company, Chewy. Cohen's involvement suggested that maybe, just maybe, GameStop could reinvent itself for the digital age. Gill began buying GameStop stock and call options, which are contracts that give the buyer the right to purchase stock at a set price in the future. Options are leveraged instruments, meaning small movements in the underlying stock can create large percentage gains or losses in the option value. Gill documented his positions openly, posting screenshots showing his account balance. At first, he was down significantly. Other users mocked him or expressed concern, but he held on, explaining his reasoning in videos and posts. He was not promising that everyone would get rich. He was sharing his genuine belief that the market was mispricing GameStop, that the short sellers were wrong, and that there was value being overlooked. Slowly, his message began to resonate. Other members of Wall Street Bets started looking at the same data Gil was seeing. They saw the extreme short interest. They learned about something called a short squeeze, a situation where short sellers are forced to buy back shares to close their positions, which pushes the price higher, which forces more short sellers to buy, creating a feedback loop. If enough people bought GameStop and held it, refusing to sell even as the price fluctuated, they could theoretically trap the short sellers in a painful position. It was not a coordinated manipulation in the illegal sense. It was thousands of individuals making their own decisions, influenced by shared information and a growing sense that they could challenge the established order. Throughout the fall and early winter of 2020, GameStop's stock price began to move. It had been trading in the single digits for much of 2020. By early January 2021, it had climbed to around $20. Then it accelerated. The mechanics of a short squeeze were beginning to play out. As the stock rose, some short sellers started closing their positions, buying shares to return what they had borrowed. This buying pushed the price higher. Higher prices meant that other short sellers were now facing losses on paper and pressure from their prime brokers, the banks that had lent them the shares. Margin calls started going out, demands that short sellers put up more cash as collateral or close their positions. At the same time, call options were creating additional pressure through something called a gamma squeeze. When investors buy call options, the dealers who sell those options often hedge their risk by buying the underlying stock. As GameStop's price rose, more call options moved into the money, meaning they were becoming valuable and likely to be exercised. Dealers had to buy more and more GameStop shares to stay hedged. This created another wave of buying pressure that had nothing to do with anyone's view of GameStop's business fundamentals. It was pure market mechanics, leverage piled on leverage, creating a situation that fed on itself. By mid-January, the story had escaped the confines of Wall Street Bets and was spreading across the internet. Financial media outlets began covering it, initially with confusion and then with growing attention. Mainstream Americans who had never visited Reddit started hearing about GameStop. Some opened brokerage accounts for the first time just to participate. The language used in these communities was populist and defiant. There was talk of standing up to Wall Street, of punishing hedge funds that had grown rich by betting against struggling companies. It was not purely about making money. For many participants, it felt like a form of protest, a way to send a message that retail investors mattered and could move markets. One hedge fund in particular found itself at the center of the storm. Melvin Capital Management, run by a trader named Gabe Plotkin, had a significant short position in GameStop. As the stock climbed into the 20s, then the 40s, then past $100, Melvin Capital's losses mounted into the billions. The fund was forced to accept a cash infusion from two larger firms, Citadel and Point72, just to stay solvent. This was extraordinary. Hedge funds occasionally blow up from bad bets, but for a fund to require an emergency bailout because of a retail trading frenzy in a mall video game store was something few had imagined possible. The week of January 25th, 2021 was chaotic. GameStop's stock price was moving in ways that defied gravity. It briefly touched nearly $500 per share, up from less than $20 just weeks earlier. The market capitalization of this struggling retailer temporarily exceeded that of many healthy, profitable companies. Trading volume was immense. On some platforms, GameStop was the most traded stock, surpassing giants like Apple and Tesla. Social media was flooded with screenshots of gains, stories of people paying off student loans or medical bills with GameStop profits, and an electric sense that something historic was happening in real time. But behind the scenes, stress was building in the infrastructure that makes markets function. When you buy a stock on your phone, the transaction does not settle instantly. There is a 2-day clearing and settlement process managed by organizations like the Depository Trust and Clearing Corporation, or DTCC. During those 2 days, brokerage firms have to post collateral to guarantee the trades will complete. The amount of collateral required is based on the volatility and volume of trading. As GameStop and a handful of other heavily shorted stocks exploded in price and volume, the collateral requirements for brokers like Robinhood skyrocketed. Robinhood, which had grown quickly by offering free trades, suddenly faced a cash crunch. They did not have enough money on hand to meet the DTCC's demands. On Thursday, January 28th, Robinhood made a decision that would become one of the most controversial moments of the entire saga. The company restricted the ability to buy GameStop and several other stocks. Users could sell their shares but could not open new positions. The reaction was immediate and furious. Millions of retail traders felt betrayed. Conspiracy theories spread rapidly. People believed that Robinhood had been pressured by hedge funds or by Citadel, which both processed Robinhood's orders and had helped bail out Melvin Capital. Accusations of market manipulation and corruption filled social media. Politicians from both parties issued statements criticizing the restrictions. The CEO of Robinhood appeared on television trying to explain that it was a liquidity issue, a technical requirement, not a plot. But trust had been broken. When buying was restricted, the short squeeze dynamics reversed. Without the constant buying pressure from retail investors, the price of GameStop began to fall. Short sellers who had held on or opened new positions at higher prices started to cover, but now they were doing so on the way down. The stock that had briefly touched nearly $500 dropped to around $100 within days. Many retail investors who had bought at the peak found themselves holding shares worth far less than what they paid. The dream of a populist financial revolution collided with the hard reality of market mechanics and counterparty risk. The system had mechanisms built over decades to protect itself from excessive volatility. Those mechanisms had kicked in, and retail investors, despite their numbers, found that they did not control the infrastructure. In the weeks and months that followed, the story continued to unfold in slower, quieter ways. Congressional hearings were held. Lawmakers questioned the CEO of Robinhood, Keith Gill, and representatives from hedge funds and clearing firms. The testimony revealed the complexity of modern markets, the role of payment for order flow, the concentration of power among a few large market makers, and the challenges of ensuring fair access. Some argued that the system had worked as designed, preventing a potential collapse. Others argued that the system was rigged to favor institutions over individuals, and that the restrictions on buying GameStop proved it. GameStop's stock price did not return to where it started. It settled into a new, higher range, bolstered by the attention by Ryan Cohen's growing role in the company's transformation efforts and by a core group of investors who continued to hold shares with an almost religious conviction. These holders, who called themselves apes and diamond hands, refused to sell even as the price fluctuated. For them, it remained a symbol of resistance, a bet not just on a company but on a principle. Whether that principle was sound investing or wishful thinking depended on who you asked. The hedge funds involved faced different outcomes. Melvin Capital eventually closed in 2022, unable to recover from the losses and the reputational damage. Gabe Plotkin returned investor money and wound down the fund. Other short sellers learned painful lessons about concentration risk and the danger of underestimating retail sentiment. For some, the GameStop squeeze was a once-in-a-career disaster. For others, it was a data point in a long series of market cycles, something to study and adapt to, but not an existential threat. Robinhood's reputation suffered significantly. The company went public later in 2021, but the IPO was met with skepticism. Many of the retail traders who had once championed the platform now viewed it with suspicion. The episode raised broader questions about the democratization of finance. Zero-commission trading had brought millions of people into markets, which was in many ways a positive development. But it had also created a generation of investors who learned through trial and error, often with real money at stake, without the guardrails or education that previous generations might have received. The gamification of investing, the use of confetti animations, and push notifications by apps like Robinhood came under scrutiny. Were these tools empowering people or encouraging reckless speculation? For the broader market and for investors trying to make sense of what happened, several lessons emerged. Not as simple rules, but as themes to consider. The first is the power and the danger of leverage. Short selling is a leveraged bet. Options are leveraged instruments. Margin, borrowing money to buy stocks, is leverage. Leverage amplifies gains, but also amplifies losses. Many of the most dramatic moments in the GameStop story came from forced liquidations, margin calls, and the cascading effects of leveraged positions unwinding. A long-term investor who simply owns shares outright can weather volatility by holding through it. A leveraged investor may not have that luxury. When the market moves against you and you are using borrowed money or complex instruments, you can be forced to act at the worst possible moment. The second theme is the importance of understanding what you own and why you own it. Some people bought GameStop because they had researched the company, believed in the turnaround potential, and were willing to hold through volatility. Others bought because of social pressure, fear of missing out, or the excitement of being part of a movement. When the price fell, those who bought for the wrong reasons or without a clear plan often panicked and sold at a loss. Investing based on genuine analysis and conviction is not a guarantee of success, but it provides a foundation to stand on when markets get wild. Investing based on hype or emotion leaves you vulnerable to whiplash. The third theme is liquidity and market structure. Most retail investors do not think about clearing houses, collateral requirements, or payment for order flow. The GameStop episode revealed that these technical details matter. Markets are not just a simple exchange of buyers and sellers. They are complex systems with intermediaries, rules, and risk management protocols. When stress enters the system, those protocols activate, and they can limit your ability to trade. Understanding that you are participating in a system, not just making isolated decisions, is part of being an informed investor. The fourth theme is the role of information and community. Wall Street Bets demonstrated that information is no longer controlled by a small elite. Retail investors can access research, data, and analysis that was once the domain of professionals. They can organize, share ideas, and act collectively without any formal structure. This is powerful, but also risky. Information can be right or wrong. Communities can reinforce each other's biases. The wisdom of crowds is real, but so is the madness of crowds. Learning to evaluate information critically, to distinguish between thoughtful analysis and emotional noise, is perhaps more important now than ever. The fifth theme is regulatory and systemic risk. The restrictions on trading GameStop raised questions about fairness and access. If retail investors can be shut out of buying during a critical moment, what does that say about the level playing field that markets are supposed to represent? At the same time, regulators and clearing firms argue that they were preventing a broader systemic failure. If Robinhood had collapsed, if the DTCC had been unable to settle trades, the damage could have spread far beyond GameStop. There is a tension between protecting individual freedom to trade and protecting the stability of the financial system. That tension does not have an easy answer. Finally, the emotional and psychological dimension cannot be ignored. The GameStop squeeze was thrilling for those who rode it up and devastating for those who bought at the top. It created intense feelings of solidarity and betrayal, of triumph and loss. Markets always involve emotion, but social media and instant communication amplify those emotions. The fear of missing out drove people to take risks they might not have taken otherwise. The euphoria of watching gains multiply created a belief that the rules did not apply. And the anger when the tide turned fueled conspiracy theories and blame. Managing your emotions, staying disciplined, and not letting the crowd dictate your decisions are timeless lessons, but they were tested in new ways during this episode. As the months passed and the intensity of the GameStop story faded from daily headlines, the market moved on to other stories, other trends, other squeezes and bubbles and corrections. The participants in the saga went their separate ways. Keith Gill, who had become a folk hero to some and a reckless gambler to others, stepped back from the public eye. Ryan Cohen worked on transforming GameStop with mixed results. The millions of retail investors who had opened accounts during the frenzy either continued trading, learning, and adapting, or closed their accounts, having learned that markets were not as easy as they had seemed. What remains is a story that fits into a much longer history of markets, manias, and human behavior. From the tulip mania of the 1600s to the South Sea bubble, to the dot-com boom, to the housing bubble of 2008. Markets have always moved through cycles of optimism and despair. New technologies, new instruments, and new participants change the details, but not the fundamental patterns. People chase what is rising. They believe that this time is different. They underestimate risk when things are going well, and overestimate risk when things are going badly. And eventually the cycle turns. For you listening to this now, perhaps in the quiet of your room, as the day ends, the lesson is not to avoid markets or to fear them. Markets are tools, mechanisms for allocating capital and sharing in the growth of economies and companies. But they are not games, and they are not guaranteed paths to wealth. They require patience, discipline, and humility. The GameStop story is a reminder that no matter how sophisticated the technology becomes, no matter how much information is available, investing is still fundamentally about making decisions under uncertainty, managing risk, and living with the consequences of those decisions. Take a slow breath. Let the tension of the story ease. The market will be there tomorrow and the day after. The cycles will continue. There will be new manias and new corrections. There will be new technologies that promise to change everything. And through it all, the principles of sound investing remain. Diversify your holdings so that no single bet can ruin you. Understand what you own and why. Avoid excessive leverage. Think in years, not days. And remember that the goal is not to beat the market or to prove something to the world. The goal is to build wealth slowly, to protect what you have, and to give yourself the freedom to live the life you want. The screens are dark now. The trading day is over. The numbers will change tomorrow, but tonight, they do not matter. Rest easy, knowing that markets are cyclical, that no boom lasts forever and no crash is the end. Time passes, prices fluctuate, and patient investors, the ones who can hold through the noise and the fear and the excitement, are the ones who tend to come out ahead in the end. Sleep well